had a very dramatic rebound in world stock markets today. Started in Asia, strong rebounds also in Europe, and here in the US. The question is exactly what has driven it. As you can see, the S&P 500 is now right back at the top of its range since that dramatic correction in August. It hasn't broken through that range, but it's right at the close of it. You'll notice also that it never got below the level from the last very aggressive correction back in October of last year, widely referred to as the bonds flash crash. Now, what has been driving this? Obviously, we had non-farm payrolls data on Friday, which was very disappointing. Initially, you saw a sell-off and then you saw a rebound. The most natural explanation would be that in this case, bad news is good news because it means that rates stay lower for longer. However, various other asset classes don't fit with that. We've seen bond yields rise today, not what happens if you think rates are staying lower for longer. Commodities really haven't done very much, maybe up very slightly today, but not an impressive clear-cut picture. Then we get to the dollar, which should logically be weakened if people think that the Fed really isn't going to be raising rates any earlier than anybody else. And if we take a look at this next chart, you can see that actually the dollar hasn't done anything at all much against its major trading partners. That's the US dollar index in blue there, which includes currencies like the euro and the yen. Where you do see quite a dramatic rebound in the last few days is in emerging markets foreign exchange, perhaps noticeably the Brazilian real and the South African rand. Those currencies had obviously been sold off very aggressively. There was a suggestion that even if the news was very bad for emerging markets, which it is, that sell-off had gone too far, and we've seen a very strong rebound from there. This could simply be a response to oversold conditions and valuation. Now you get a similar picture if you take a look at the guts of what has happened in the US equity market, as we can see from the next chart. What we're looking at here are the two best performing stocks today in the S&P 500, which are Alcoa, the aluminium producer, and Micron Technologies, which makes semiconductors. Both very cyclical stocks, very prone to the global industrial cycle, and both had done really terribly for the year so far. Now, in the case of Micron, what is even more intriguing is that they have been spurred by their latest earnings announcement, which came out after the market on Thursday, which was bad and disappointing and involved talking down estimates for the future, but didn't talk down estimates quite as much as some brokers had feared. The fact that you got that kind of a rebound from what was essentially a very bad, very negative earnings report suggests that some of the fear that has been written into earnings forecasts has been overdone, and that we could indeed be primed to see quite a rebound without that much in the way of good news from the earnings season once it gets underway. When it comes to Alcoa, of course, they will be the first company to report later this week, starting off that earnings season. I do think the third quarter earnings season really is now critical. If we want to see the S&P break up out of its range, that will require some reasonably good numbers from the earnings season. It's still possible if companies choose to kitchen sink, throw lots of the bad data into their numbers, and to guide downwards. It's still possible that it will take us back down again. The bottom line is that earnings season really matters.